Welcome back. Now to our first conversation. We see the National Bureau of Statistics at the weekend revealed that in the fourth quarter of 2022, Nigeria's domestic and external debt profile hit 46.25 trillion. In terms of composition, the total domestic debt stock was at 27.55 trillion naira, while the total external debt stock stood at 18.70 trillion naira. Joining me now is Chinwe Grim, Chief Economist, Coronation Merchant Bank. To give me a perspective. Great to have you on the show. Good morning.
Good morning. Thanks for having me.
So, Chinwe, it's a 6.69 trillion increase from 39.56 trillion in December 2021. That's just about 1 year. What came to mind when you saw this report?
Ladi, the total debt stock, as at the end of last year, stood at about 46.2 trillion naira, and this year-on-year increase is in the total debt stock is not surprising, given that the FGN's projected budget deficit for 2022 was about 27% higher than what was set in 2021. Now, last year, there was visible reliance on domestic borrowing compared with external borrowing, and this was really on the back of Nigeria's absence from the international capital market, which has been partly due to the hawkish monetary policy stance adopted by select central banks across advanced economies. And of course, what did that do? That led to upticks in interest rates. The approximate ratio that we're seeing, or that we've seen, which is about 60-40 for domestic versus external borrowing, seen in recent release, reflects this trend that I've just expressed. Now, we did notice that there was underperformance in 2021 when we consider the target that the FGN has set in the budget of that year. I believe actual revenue for 2021 was about 78% of expected total revenue. And for 2022, revenue performance based on January to November, which is the latest data that we have, was relatively better, but can still be regarded as underperformance, as the actual revenue between this period, January to November, is about 87% of the expected 2022 total revenue set in the budget. And all of this matters when we're discussing borrowing or the debt stock. Let me also shed some extra light on domestic borrowing. The FGN's share of total domestic debt, based on the data released, accounted for about 48%, while states and the FCT collectively accounted for about 12%. It's worth noting that the DMO exceeded its borrowing target for 2022 by about 553 billion naira. And this was through its monthly bond auctions, right? In the secondary markets, the average yield for FGN bonds was at double digit at the end of December. It stood at about 13.04%. Also worth mentioning is that the DMO attributes the increase in the debt stock to, one, new borrowings by the FGN and subnationals, primarily to fund budget deficits and execute on projects. And secondly, the issuance of promissory notes by the FGN to settle some liabilities also contributed to the growth in the debt stock that we've just seen.
All right, looking at the composition now, we see obviously domestic debt is, more, compared to foreign debt. But looking ahead, what is your view on, domestic debt and your thoughts on market rates?
Okay, well, considering the maturity profile of current FGN debt instruments, the first half of this year brings with it improved system liquidity. However, in H2, that is second half, we expect continuous tightness in the interbank market as the FGN front loads domestic borrowing due to its projected budget deficit that I mentioned earlier. And also our expectation of continuous low activity with regards to external borrowing. The expected demand and supply dynamics of FGN debt instruments in 2023 point towards upticks in yields in the domestic debt market. Now, over the next 3 months, we expect the average FGN bond yield to range between 13.7% to 14.9% at the middle of the curve, and slightly higher at 14 to 16.2% at the longer end of the curve.
And definitely, we've had that argument. We've seen experts talk about debt, not being a bad thing, in itself, but, you should be able to pay your debt. That's one major issue there. But if you're generating enough revenue, as a country, then obviously, rising debt shouldn't be a problem. But what do you think can be done to increase, revenue generation, in the country?
That's a really good question, but let me try and give you a few answers off the top of my head. I would say the planned removal of the PMS subsidy should support increases in retained oil revenue, boosting security and efficiency across oil production value chain will also have a significant impact on revenue. Boosting non-oil revenue by broadening the tax base, plugging loopholes, and enhancing collection efficiency by deploying technology and automation would also help. I think boosting export receipts from agricultural products, minerals, and manufactured products, which require tackling logistics issues such as storage, packaging, and warehousing. I think something to note as well is that manufacturers continue to struggle with producing profitable standard products able to compete in the global village due to infrastructural issues. So these issues need to be tackled as well if we're working towards enhancing or boosting revenue.
And obviously, we've seen, analysts talk about how the new incoming government would also have to, keep borrowing to, fill some of these deficits. But what's your outlook for Nigeria's debt level going forward?
Okay. Well, an expansionary fiscal policy posture has been adopted in the current administration, and we do expect to see the same trend, at least in the medium term, with the incoming administration. Now, the ratio of capital to recurrent expenditure is expected to be higher over the next few years. So that ratio is actually 30 to 70. So we expect to see a slight shift with that ratio. An expected spike in capital expenditure will impact deficit financing gaps. So we expect the domestic market rates to trend up as continuous reliance on domestic borrowing versus external borrowing is likely to keep yields on the fixed income instruments elevated.
Q1 is over now, and obviously was a challenging, some have described it as challenging quarter, and now Q2 is upon us. What are your expectations for Q1 GDP for 2023?
Well, for Q1, we expect GDP growth to moderate to a level within 2.3 to 3.3% from 3.5% that was recorded in the final quarter of last year. Now, some factors that are influencing this forecast include weak consumption patterns on the back of high inflation and its impact on service-oriented sectors, continuous transmission effect of FX depreciation on business activities, the impact of high borrowing costs on SMEs activities, and the cash scarcity effect. So the Naira scarcity effect that we've seen, which was triggered by the redesign policy, the Naira redesign policy. And also a lagged effect of the flooding crisis, which happened towards the end of last year. We actually do expect to see that impact the Q1 figures, at least for agricultural GDP output, which accounts for over 20% of the national output.
The headwinds experienced in Q1, do you see those headwinds staying with us in Q2? And what are you expecting for Q2?
Well, for Q2, we expect to see GDP growth still within the same range. I think upticks are feasible towards the end of the year, so towards the middle of Q3, Q4. And that is really on the back of how the transition effect takes place.
All right, we'll be looking out for all of that. Thank you so much, Chinwe Egwim, Chief Economist, Coronation Merchant Bank. Thank you for your perspective today. All right, so after the break, we'll be drilling down on our debt capital market as corporates debt issuance hit a new high. That was for 2022. That's our next conversation. Do stay with us.